Suncor has returned 45% year-to-date, and the obvious explanation is WTI at $95. That explanation is incomplete in a way that changes the risk profile entirely. The Iran-US conflict closed the Strait of Hormuz corridor to reliable supply, pushing WTI from roughly $57 at the start of the year to the current $95. For a pure upstream producer, that move is linear upside. Suncor is not a pure upstream producer. It processes roughly 511,000 barrels per day through 4 refineries in Canada and the United States. At $57 oil, refinery feedstock is cheap and crack spreads are wide. At $95, Suncor is buying its own feedstock at elevated cost, while selling refined product into a market where demand destruction above $90 historically compresses margins. The integrated model was designed to dampen exactly this kind of volatility, and it does. But dampening downside also means the 45% year-to-date return understates when a pure-play producer captures at these prices. Capital that entered Suncor expecting upstream leverage is holding an asset that is structurally hedging itself against the commodity move it bet on. That is not a flaw, it is the product design. The flaw is mistaking the hedge for full exposure. Canadian Natural operates differently. Its long-life, low-decline oil sands assets run with a cost structure that barely changes between $57 and $95 oil. The incremental barrel at these prices flows almost entirely to the bottom line. That is why Canadian Natural's 32% year-to-date return trails Suncor's 45% on the surface, yet the earnings quality at $95 is arguably higher per marginal dollar of oil price. The market has not fully resolved which integrated structure is actually winning this commodity cycle. Suncor shares still trade roughly 10% below analyst consensus targets even after the rally, not because the market is ignoring the oil price, but because the consensus built those targets at a different refining margin assumption. If WTI stays above $90, the refinery drag that compressed Suncor's multiple relative to pure-play producers becomes the number analysts revise upward first, and that revision has not happened yet. But the revenue that both companies generate at $95 oil has a ceiling that neither company controls, and it sits inside a macro constraint that the oil price rally is actively worsening.
Canadian Natural's Q1 2026 beat looks clean on the surface. Revenue of $7.88 billion exceeded the consensus estimate by 5.22%, and EPS of 85 cents beat by nearly 15%. The part of that beat that matters for the forward thesis is not the revenue line. Canadian Natural delivered that earnings surprise while producing 1,198,079 barrels per day, roughly 10,000 barrels per day below the analyst estimate of 1,200,025. An earnings beat on a production miss means the entire positive surprise came from price, not volume. At US $95 WTI, that is exactly what you expect. The concern is what happens when the price variable normalizes and the production shortfall remains. The 25 consecutive years of dividend growth and the current 4.1% yield at $60.89 per share rests on that cash flow consistency. 25 years of raises survived the 2008 crash, the 2014-16 downturn, and the pandemic. What none of those cycles tested simultaneously was a price spike accompanied by an infrastructure ceiling on how many barrels can reach price discovery markets. Western Canadian export pipelines are already operating with only 300,000 barrels per day of surplus capacity, against 4.6 million barrels per day of supply. Canadian Natural's long-life assets are designed to grow production toward that 5.2 million barrels per day the S&P Global Supply forecast shows by 2030, but the pipeline math means that growth lands in a constrained system unless new capacity clears before that supply arrives. The Q1 beat, in other words, is a ceiling signal disguised as a growth signal. At current infrastructure, the production miss is not random noise. It reflects the same export constraint that caps how much incremental volume either producer can monetize, regardless of the commodity price. What resolves that ceiling is not the oil price. It is a routing decision that two governments signed 4 days after Canadian Natural reported earnings.
The Carney-Smith agreement, signed May 16, sets a federal approval path for a new West Coast oil pipeline by fall 2027, and the routing direction embedded in that approval is the variable that reprices Canadian producer netbacks, not the approval itself. The WCS-WTI differential is the spread between what Alberta heavy crude actually sells for and the US 95 benchmark. That spread exists partly because of transport cost and partly because Canadian producers are captive to a limited set of buyers, primarily US Midwest and Gulf Coast refineries. A south-routed expansion, similar to Keystone XL, deepens that dependency and keeps Canadian producers exposed to U.S. tariff and trade policy risk on top of the commodity risk. A West Coast route opens Pacific pricing, where Asian buyers, particularly Japanese and South Korean refiners, bid against U.S. buyers for the same barrel. That competition compresses the WCS-WTI differential structurally, not cyclically. Trans Mountain's announcement of an open season to add 300,000 barrels per day by end of 2028 is the existing West Coast precedent, but it is not new capacity. It is an expansion of a system that already exists. The Carney-Smith deal is a commitment to a separate, additional artery that no private proponent has yet stepped forward to build. The fall 2027 federal approval signal is therefore not an infrastructure event. It is a capital formation signal. The question it answers for Suncor and Canadian Natural is whether the new capacity gets built at all before the 2030 supply overhang materializes, and under what cost of capital conditions. That cost of capital question is where the oil price tailwind turns against itself. New Fed Chair Kevin Warsh, known as an inflation hawk, is presiding over a rate environment where markets are pricing in fewer 2026 cuts, precisely because the US 95 oil that benefits Suncor and Canadian Natural is itself the inflation input driving yields higher. Higher Treasury yields raise the discount rate on capital-intensive oil sands projects. The pipeline that needs to be financed by fall 2027 is exactly the kind of long-duration, capital-intensive asset that a higher-for-longer rate environment reprices most severely. If WTI holds above US 90, the same threshold that validates the current stock returns, it keeps rates elevated enough to make the pipeline financing materially more expensive. The two conditions that investors are treating as simultaneous tailwinds are structurally in tension with each other. Suncor, sitting 10% below analyst consensus targets after a 45% rally, closes that gap only if refining origins recover and pipeline capacity expands before the export ceiling tightens further. Canadian Natural's dividend growth streak, 25 years, survives only if the 2030 supply forecast does not arrive into the same 300,000 barrels per day of surplus the system carries today. Both outcomes hinge on the fall 2027 approval becoming a shovel, and the rate environment between now and then determines whether any private proponent can afford to pick one up. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.